India's pharmaceutical industry is no longer just about the low cost tablets and generic exports. It's about scale, innovation, and margin discipline. There is one Indian pharma company that quietly built a strong domestic franchise, expanded its global footprint, and at the same time improved operating margins when many peers struggled. Over the last few years, its sales have scaled up meaningfully, profits have grown, and operating margins have crossed the 30% mark. Yet, the stock still moves with volatility. Is this because the market is missing something, or because there are risks hiding beneath the surface? Hello everyone, I am Sebi George and you are watching Decoding Equity. Let us decode the numbers and find out. Today, we are analyzing one of the top 5 pharmaceutical companies in India in terms of sales, that is, Zydus Life Sciences Limited. Before we begin, disclaimer, this video is strictly for educational purpose only. I am not a SEBI registered investment advisor and this is not a buy or sell recommendation. Please consult your financial advisor before taking any investment decision. Zydus Life Sciences has delivered a clearly improving sales trajectory over the last 12 quarters. While there are normal quarter-to-quarter fluctuations, the broader trend turns decisively positive from financial year 2024 onwards, with sales consistently moving to a higher base. This indicates better scale, strong execution, and improved product traction rather than one-off growths. Overall, the last 12 quarters reflect a company that is steadily scaling up its revenue engine despite short-term volatility. Zydus Life Sciences has shown a structural improvement in operating margins over the last 12 quarters. OPM has gradually moved from the low 20% range to consistently above 30% in recent quarters, even with some interim volatility. This margin expansion reflects better operating leverage and improved product mix and tighter cost control, indicating that the profitability gains are sustainable rather than one-off. Zydus Life Sciences has shown a clear improvement in profit performance over the last few years. While quarterly profits remained volatile, the underlying trend strengthens from financial year 24 onwards, supported by higher operating margins and better scale. Fluctuations in profit are largely driven by other income tax rate changes and rising depreciation rather than weakness in core operations. Overall, the profit trajectory indicates a stronger earnings base with volatility coming from below the line factors. Zydus Life Sciences show a strong and reassuring relationship between profits and cash flows over the last 5 years. Cash flow from operation broadly tracks reported PAT, and in some years, especially in financial year 2025, the cash from operation is significantly higher than the profit. This clearly indicates that earnings are backed by real cash, not aggressive accounting. Overall, the CFO versus PAT trend reflects high earnings quality and healthy working capital management, which is a positive sign for long-term investors. Over the last 5 years, Cydus has shown a clear improvement in capital efficiency. ROE has moved from the mid-teens in financial year 21 to around 21% by financial year 24-25, reflecting stronger profitability for equity holders. ROC has improved even more sharply from high teens levels to 24% in recent years, supported by margin expansion and better asset utilization. What is important here is that this improvement in ROE and ROCE is not debt driven. It is largely backed by higher operating margins, better scale, and strong cash generation. Overall, the last 5 years show that the Cyrus is deploying capital more efficiently, which materially strengthens its long term investment quality. Over the last 12 quarters, Cyrus has seen a steady rise in foreign institutional ownership, with FII holding increasing from around 3% to over 7%. Domestic institutional holding has moderated but stabilized around 11%, reflecting portfolio rebalancing rather than an exit. Importantly, the combined FII and DII holding has remained totally stable, indicating that overall institutional confidence in the company has not reduced. Cydus has a well-diversified sales mix with revenue coming from India, the US, and other international markets. The India business forms a strong and stable base, driven largely by chronic therapies such as cardiodiabetics, gastro, and respiratory, which supports margin stability. The US and global markets add scale and growth opportunities, though they bring pricing and regulatory volatility. Even though the US has imposed higher tariffs on several imported goods, These do not typically apply to generic medicines, which are treated as essential products. A large part of Zydus Life Sciences US export consists of generic medicines, so direct tariff impact is limited. That said, with the policy uncertainty, especially under a Trump-led administration, sudden changes cannot be completely ruled out. Apart from tariff, price pressure from policy changes, buyer consolidation, and reimbursement rules remains a more consistent risk for the US generic market. Compared to peers like Aurobindo and Dr. Reddy's, Lupin, and Sun Pharma, Zydus Life Sciences US exposure is moderate, offering a better balance between growth and risk. Companies with very high US dependence are more vulnerable to policy, pricing, and regulatory shocks. Cyrus has continued to invest in fixed assets, reflecting ongoing capacity expansion, compliance upgrades, and manufacturing capability enhancement. These additions support future growth and product complexity, also explain the gradual rise in depreciation seen in recent years. Cyrus Life Sciences saw its debt-equity ratio increase from about 0.13 times in March 2025 to around 0.38 times by September 2025, mainly due to a sharp rise in the borrowings. Importantly, a significant part of these borrowings was used for fixed asset purchases, indicating capacity expansion and long-term investment rather than balance sheet stress. Even after this, the increase leverage remains comfortable and well supported by strong operating cash flows. Cyrus Life Sciences is currently trading at a PE of around 17-18, which is among the lower valuation levels seen over the last 3 years. Compared to peers, Sun Pharmaceutical Industries, Lupin, and Cipla trades at a higher PE. Overall, Cyrus valuation suggests the market is still cautious on the generic business, despite improvements in the margins, cash flows, and balance sheet strength. To sum up, Cyrus Life Sciences stands out for its consistent financial performance, improving efficiency, strong cash flows, and stable promoter backing. While near-term risks like US pricing pressure remain, the company's fundamental strength and conservative financial structure make it a business worth tracking from a long-term perspective. As always, this is not a buy or sell recommendation, but an effort to decode the numbers and understand the business better. Remember, successful investing is about understanding the business, not chasing noise. I am CF Sebi George, and you are watching Decoding Equity. Thank you for your time and see you soon.